Good morning, Southern California, your hometown station, KHTS. This is Fred Arnold on the Santa Clarita Business and Real Estate Show. I'm joined by Harry Beeson. Harry Beeson's a really good friend, a client, a professional when it comes to tax. Harry Beeson's a shareholder in the Glendale, California accounting firm of Beeson, Hoffman, and Siddle.
Right.
And he also specializes, including manufactured companies, distributors, contractors, nonprofit, and employee benefits plan, amongst many others.
Sure.
Welcome to the show.
Hey, great. And you're a fellow Bruin like me.
That's right. I love the Bruins. My daughter just graduated, and my son's at UCLA right now.
All right.
Yeah. So, Harry, tax reform. That's why I brought you in. We got
Sure.
10 minutes on tax reform.
Yeah, December
good-
22nd,
Yep.
Trump signed the bill, biggest tax reform since 1931.
So let's talk about the good and the bad and the ugly.
The good is the rates went down, and they've doubled the standard deduction from like 12,000 if you were married to 24,000, singles from 6,350 to 12,000, and the child tax credit went from 1,000 to 2,000, and that would usually phase out once you got to the kid turned 17. Now that's going to go all through 22 if they're in college. Plus, they raised the phase out on the income. Usually, when you hit $110,000, you start losing those child tax credits. Now it's going to go up to 400,000. So a lot of people are going to get the child tax credits, and that's going to offset some of the bad things we're going to talk about, which is they've now limited state and local income tax. We're talking state income tax, which California is very high. All the blue states, New Jersey, New York, we have very high state income taxes, high property taxes, especially here in Santa Clarita. I have a lot of clients in Santa Clarita. Most of them pay $10,000 or plus in property taxes every year, with Melrose. And also the DMV fees. We have high DMV fees in California.
And they just went up this year.
And they went up.
Yes, they went up.
We have a lot of clients that you look at their state and local income taxes, you're talking 20, 30 grand in taxes, and those are going to be limited to 10,000. So it's really hitting us Californians hard. My taxes are going up 5 grand. I already figured it out. So that's been the downside. The good side is we have a bill pending in California right now to make our state income taxes deductible as a contribution.
Right,
And
okay.
that's legal in several other states. It's called the California Excellence Fund. Right now on your state income tax on page 4 of your state return, you can check the box. I want to give another $1,000 to this state contribution. So you can, this is pending, and this is legal in several other states. So I think it's going to go through, and they're going to let you change 85% of your state income tax into a contribution. And I sure hope it goes through.
Yeah, because that'll increase that. So let's talk about real quickly the good. For those that are typically renting, for those with incomes, I want to say under 100, 150,000, it sounds better because your state and local income tax perhaps aren't above that.
Right. For people
And
that had less than 20, especially if they don't own a house, or even a lot of our old clients, they've paid their house off, their property taxes are 2-3 grand a year. They're way under the 24,000 on the standard deduction. So for them, it's a decrease, and the rates have gone down. But for a lot of people like you and me, rates are going up.
Right. So let's talk about that. It's the actual property tax, so the amount you write to the LA County tax collector. You do that in, April and November.
November.
So those are the ones capped at $10,000.
$10,000 income tax, DMV fees, and property tax.
All three of them combined.
All three combined, $10,000 limit.
Because, you think about somebody that buys a house for $600,000, kind of an entry-level home.
Sure,
nowadays.
Yes, $600,000. Your tax, Dave's going to be what, $6 grand a year?
Yeah, we're somewhere right around there.
Oh,
Yeah.
more sevens.
yeah.
I see the bills. 7,000.
Yeah. And so that covers 7 already,
And
which
then
means
3,
that-
and probably his income taxes were 10 or 15. He's going to see a limit that's really going to hurt him in the pocketbook, unless he's got a bunch of kids. My partner's got 6 kids. His tax credit just went from 6,000 to 12,000.
So we have to have more kids. That's what
That's
you're
it.
saying.
Come
right?
on.
Okay.
kids are not
need some
cheap.
more
Hold on.
Bruins,
Yeah. Do you know how much they cost? Without a doubt. And so those are the things that become challenging.
Let's talk about mortgage interest.
Yeah, that's
that's
so
important to
it's
us.
capped. So let me put a stab at this. It's capped at $750,000 if you're going to claim it as
Right.
your primary residence, correct?
Right. It does not apply to rentals. That's a big Schedule E rentals. There's no limit. It's only Schedule A personal residence.
What about second homes?
Second homes are, well, it depends if it's a rental or but it's personal. No,
I
$750.
see. So if you're going to buy a second home, you might want to rent it most of the year.
Yeah, you can only use it up to what, 10%.
What is it? Is that what it is?
14 days or less.
14
and all
days, I
that.
think.
So, but we are limited to 750, and that was for contract for anyone that was had bought the house before 12/15/17. You're grandfathered. I've got clients at 1.5 million. Now the big limit for us that were grandfathered has gone from 1.1 million down to $1 million. We had $1 million in acquisition debt on the first mortgage, and we had up to 100,000 on home equity. They still are allowing home equity. One of the things we've seen people aren't understanding, you can have 750 total of the first mortgage and the home equity debt. So you could buy a house for 500,000 with the home, the first loan, and then you could still have a $250,000 home equity line.
If it's acquisition debt.
Acquisition debt, it's got to be for improving the house.
Yeah. Let me ask you this, and throw a couple things at you. Let's say they're refinancing a first and a second they've had the loan for some time. They bought it a long time ago. They bought a house, their loans for $650,000, just under the high balance limit. And then they have a $250 line of credit. So the combined loan is above $750,000. From what I understand, that's grandfathered in, but are they allowed to do that, take cash out to pay home equity?
My understanding is, yes, if they own the house and they had the debt before 12/15/17,
It's
the
there.
refinancing's grandfathered in.
Right.
I can verify that. You're the first one to ask, but that's my understanding. It's if the loan was in there and they owned the house before December 15th of 17, they're grandfathered in. Thank God.
Yeah.
It's me.
There you go. So one way to strategize would be if you're buying a higher end home, and especially over the coming years as incomes slowly rise, buying a house for $800. I mean, you think about this, Harry. If you're a teacher, been doing it for 25 years, you're making about pretty decent, $75,000. If you are a principal, maybe a little bit more, right?
I have principals, they $105,000.
Okay, so they're making 100, and a peace officer or a fireman overtime making 115. So between the two, they're 225. That's not unreasonable for them to buy a $1.2 million home.
Right?
And if they're a veteran, they can continue to buy at minimal money down above the limits. So it's not unreasonable for those that are considered middle class to not get these
California
deductions.
is very common.
Yeah.
And I also want to ask, so because I've had discussions on this as well. There's a little bit of a misconception. If you have mortgage debt over that $750,000, you can still write off the mortgage debt up to $750,000.
$750,000, right? Like I have clients at $1.5 million in debt, and we've been taking $1.1 million. So the ratio, whatever it is, almost 2/3 has been deductible. Right. So they just have part of the interest isn't deductible.
Right. So some people think you can't deduct it at all. That's not the case.
It's just the
No.
percentage of
over
So for
750,
all of
right.
us that have had debt over over the 750 we will be able to deduct up to $1 million of debt interest.
Yeah. If you had the loan prior to
Right.
December 15th.
of 17. That's the big deadline.
That's great. Anything else you want to share on what's going on? Because I know you're busy, so you got to get back
really
to the office.
busy. I was doing tax return. I mean, our tax software does showing the 17 tax returns. We get a little summary, and then it's showing 18. And I'm amazed that people that are making 150 to 200, a lot of them with the kids, the taxes are going down because they're getting that $4,000. They're getting $2,000 tax credit, and the kids that are in college normally, and once they turn 17, it's gone. So I'm seeing a lot of people actually their taxes are going down a little bit.
Yeah.
Other people it's going up. Other big thing that's hitting people, alimony will no longer be deductible after 12/31/18.
So I got an opinion about that.
I'm sure you do.
Being split family, I pay alimony, no secret, and that's unfortunate for. The computers are going to adjust, which means that the spouse or the ex-spouse that's receiving the money is typically less economically advantaged.
Right.
Who's it going to hurt the most?
She's in a lower tax bracket.
Exactly. Right. But it's going to hurt her more or him more if the woman happens to be making more money. It's going to be hurt the person that needs the money the most.
Right.
And that's what's unfortunate about it. So you're going to disproportionately affect the cash flows of many women and some men that really need the money most. And the unintended consequence is unfortunately going to be that.
Yeah, I agree.
Because the
Right.
person spending the money has a lower tax bracket.
Right.
Right, right. And so that's what they're doing. They're doing that because they know the man's in a higher tax bracket, so that non-deductible alimony is going to be taxed higher.
But he's not using it. She is, and she's in a
Right. No,
household.
the,
Right.
the man
Yeah.
paying the alimony is really being screwed here.
Yeah. Well, I think the computers will adjust, and I think what's going to end up happening is the computers will adjust, and the lady, in the cases where
Well,
it's
it's going to be
traditional,
negotiated between the attorneys. They're going to have to take into the tax
the attorneys
effects.
will make more money. But I think the unintended consequence is those that need it most are going to be affected.
You're
by
right.
it.
The man's going to fight for a lower amount.
Yep, and then
Right,
and the other
right.
person's going to get a little bit less, and
Right.
and that's going to be the unfortunate unintended consequence of
Right.
it.
This
is the-
bill was rushed. 6
Yeah.
weeks. 80 and 86, they spent a year and a half writing the tax bill.
Yeah.
This was done in 6 weeks. Some of it was written on toilet paper. I mean, it's
Kind
ridiculous.
of reminds me of the Dodd-Frank bill.
Yeah.
Anyhow, Harry Beeson, how can those that reach out to you get you?
Sure. Just call my office, 818-240-8322, or email me, hbeeson, HBEESON, at bhscpa.com.
And he loves sports. Did you know he loves skiing? And loves the Bruins.
Go Bruins.
Harry Beeson, thanks for coming in.
Great seeing you, Fred.
Absolutely. Ladies and gentlemen, I hope you enjoyed this edition of the Santa Clarita Business and Real Estate Show on your hometown station. I'm your guest, Fred Arnold on KHTS.